as I'm sure you have all seen over the last couple of months here, we've seen a dramatic increase in soybean and corn prices. There's a bunch of different reasons for what's went on. Just giving you an idea, this is the board right now. As of this morning, you can see corn prices on the nearby side are about $4.36, with the harvest at $4.45. Soybeans at $11.71, and harvest is down around $11.47 when I last checked. So when we end up looking at what some of the reasons behind this dramatic increase,
there's a few things that I want to primarily talk about. So the first one that has been in the news quite a bit has been South American. Just a sec, I think I lost mine.
all right. Andrew, can you see that?
Yeah, now you're good.
Okay,
yeah.
Sorry about that.
Go with it from there. I think we can. Some reason you cut out and it volume messed up, but I think talk real quick and we'll see.
Okay, there's kind of 5 primary factors that have moved markets recently. First one is South American weather. There's been some issues down south. Particularly, Argentina had some really wet conditions during their harvest, which affected their soybean yields and production down there. Brazil has recently went through a dry patch that's affecting their second crop, corn. They've actually had a tremendous spike in the price of corn. Have been looking at importing corn from the U.S., which is beneficial to our prices. The other one that's continued to assist in prices has been the depreciation of the U.S. dollar and continued strong demand as a result, primarily from Southeast Asia, China. The other one that is kind of been on the back burner, I won't say that it's completely stabilized, but it's definitely simmering, is back in the winter we were hearing continuous reports, particularly out of China, about potentially a major correction, great deal of uncertainty. That's kind of simmering a little bit. I'm not saying that that's necessarily been completely resolved, but there's definitely less current volatility on that front. Whether that remains as is, we'll have to wait and see. The other one that's a big discussion of right now in corn and soybeans in particular has been investment money flow. There's been a tremendous amount of money that's flowed into the futures market, which has helped spur this rally. A lot of it is making some substantial bets on domestic weather. There's obviously the El Nino has petered out. Now the question is, will we transition into a La Nina, and when? The when is the one that's really difficult to predict. That is something where it could be the end of June into July, or it might hold off into the fall. It's got some real repercussions because typically when we move into a La Nina, we'll get some hot, dry conditions. Now, when you're talking weather, there's never any 100% guarantee, so of course you have to be careful with that. It is something where, again, there's a lot of unknown about this, but there's a tremendous amount of money that's flowed in to corn and soybeans. Betting on just that ended up happening both domestically and potentially in other parts of the country. So if we look at Brazil right now, and this kind of illustrates some of the stuff that's been going on, I've highlighted 2 numbers on here. One is the ending stocks for corn, and the other one is for soybeans. What this is basically a change in USDA estimates from December 2015 to last week's June report. You can see that they've continually revised down ending stocks numbers, 31% for corn, 21% for soybeans. That's, again, one of those ones where they've underestimated a little bit of the demand and also overestimated production. They've adjusted those over time, and as a result, markets have improved a little bit. Again, this is for the 2015-16 marketing year, so this is the crop that has already been produced. This isn't the one that that is growing down here right now, or the second crop in Brazil. This is the winter crop in Brazil and our harvested crop from last year. Similar thing with Argentina. We ended up seeing a decrease. I highlighted Argentinian production because this really doesn't reflect the reduction as a result of the wet weather yet. I think there's still more reduction to come. You can see that they have reduced their ending stocks. They've had a lot of political uncertainty and economic uncertainty down in Argentina. So a lot of producers have been holding beans for years and years in order to end up using that as a hedge against inflation and some other currency issues, in order to be able to make sure that they're able to pay their bills as they come due. So there's a lot of almost a barter type system down there where they keep tremendous amounts of soybean stocks. Now with the new government that's come in Argentina, they have reduced the export tariff taxes in a move to try to end up increasing grain movement. So that's something to keep an eye on. You look at the U.S. dollar index, I mentioned it's declined about 5% since the beginning of the year. When the U.S. dollar declines, it aids our exports. When it appreciates, it makes our goods more expensive. So again, that's another one to really watch. The Brazilian real, there's a huge political mess right now down in Brazil, but a lot of people right now are speculating that it's kind of hit a bottom and has nowhere to go but up. Now again, anytime you're talking South American, there's a great deal of uncertainty, but we have seen it actually appreciate. So it's increased in value, which makes their exports more expensive relative to the U.S. over the last, since the beginning of the year. So again, keeping an eye on how these exchange rates play in there is going to be important as to where we end up going from here. You look at U.S., this is the same thing. We've ended up changing numbers. We've tightened up our stocks on corn a little bit, but really we've really tightened up our stocks on soybeans. A lot of that is we continually see the USDA underestimate soybean demand, particularly China. There's one of those ones where we've seen it for about 4 years now, where they've continually underestimated demand. As they continue to underestimate demand, it ends up having an inflated ending stocks at the beginning of the reporting period, and that continues to seem to fall as we move through the marketing year. And as those ending stocks come down, prices creep up. You look at world, again, you've seen corn stocks come down a little bit. Again, this is for the 2015-16 marketing year. So for corn and soybeans, this ends August 31st, but a much bigger reduction in soybean. And we've seen that corresponding price increase in the soybean markets. I mentioned the Chinese economy. This is the Shanghai Composite Index, so kind of a rough equivalency would be the Dow Jones Industrial. So you can see back in 2015 it peaked. If you remember early in 2016, late in 2015, there was all these reports coming out of China about major economic issues. Growth was being reduced dramatically in many cases, but we've seen this kind of even out a little bit. Growth has come down, but one thing you do have to remember is that back in the early 2000s, when the Chinese economy was growing at 10-15%, it was a much smaller economy. As you've increased the size of that economy, you're going to naturally get a little bit lower growth rate, just because the size of the economy that's growing in percentage terms is going to be a lot bigger. Again, I'm not sure if we haven't seen the end of the volatility in this Chinese market. I think it's just simmering on the surface and could be revisited almost at any time. I mentioned the long or the investment money that's been flowing in here. What you can see is for the blue dashed line is corn, and these are number of contracts that are being bought and sold by investment money. So this is long minus short, so bought minus sold. And you can see right when prices took off for soybeans, right around the beginning of March, they were actually at a sold position. Since then, they've added 300 or almost 300,000 contracts of soybeans and almost 400,000 of corn, because they started at a negative number. And that coincides very well with the price increase. Obviously, this isn't necessarily driving it, but it is contributing to it. Just for a reference, when you're talking dollar amounts, 300,000 contracts of soybeans is about 1.5 billion bushels and a value of about $16.5 billion. So we're not talking about small amounts of money that are coming into these markets. We're talking about large amounts of money that are flowing into commodity markets. And what they're projecting is if they're long the market, which they are substantially right now, they are projecting that prices are going to end up moving higher. They're betting that prices are going to move higher. And a lot of that's going to center around that La Nina transition, when it ends up occurring and how it ends up reacting. You can see back, if everybody remembers last summer when we got that spike in corn, well, you can see the run-up in corn on this dotted blue line from last year, where we ended up getting that little spike in corn as they were end up concerned about a lot of the wet conditions through Missouri and that area of the country. And then we've seen a real quick reversal of that, and then we trended back down as they sold off. The thing to remember, if they're long, so if they're overbought, eventually they have to exit those positions. So again, if you see a whole bunch of money exiting those positions, it's going to increase the sell side of the equation. Now, it's a very difficult time period right now, because since this is very contingent on what people think and when people think these weather events might occur, we could see this market continue to go up on the price side, or we could see a dramatic, very quick reversal in corn and soybean markets if we get some timely rains and some of this production uncertainty is removed. So it makes it very difficult. You really have to look at what marketing opportunities are available to you, and I'll go through a couple of just quick checklist type things at the end to make sure that we have some idea of what we can end up doing. You look at the U.S. drought model. I mentioned this is kind of the focus kind of shifted to domestic weather. Well, right now, if you look at Texas area, that's your kind of your wheat. They've had fantastic growing conditions there. They've got a record a yield projected for winter wheat this year. We haven't seen any dry weather or much dry weather through most of the Corn Belt. The driest place in the corn producing region is actually lower middle Tennessee up into northern Alabama and Georgia. So again, how this changes over time, if we see some dry conditions developing through Iowa, Indiana, Illinois, or up in the Dakotas, then we could see this rally continue upward. Like I mentioned, right now, there's not a current weather scare. It's betting on a future one in July and August. So if you look, this is the upcoming marketing year. So the past screens were the marketing year that ends 2016. This will be the new crop. So when we look at where we're at, the USDA is still projecting higher ending stocks, up 18%, higher production, and that obviously coincides into higher world production. But again, they're also countering that with strong use. Now, these estimates do not account for any reduced yields due to dry and hot weather. So if there are weather issues, these aren't going to be captured in here. Now, you can see where their price is at $3.50. That's down 5%. Again, this is going to be very contingent on how the yields turn out and what their production ends up being. Similar thing for soybeans, only perhaps a little bit more dramatic. I mentioned getting a handle on the demand for soybeans and other oils has been incredibly difficult, but even without dry conditions, they are looking at an approximately 30% reduction in soybean stocks. So right now it's kind of flipped, where soybeans definitely has some upside potential. Again, it depends. If we think back to 2012, corn was definitely hit harder than soybeans in terms of a price, or in terms of production. So again, it's not just if a drought or dry weather or hot weather occurs. The key is when it's going to end up occurring, which commodity it's going to affect more. So again, these are a little bit tighter than where the corn stocks are. They're going to move somewhat together. The other thing that you do have to remember, sitting in the background, if we see soybeans really run away from corn, when Brazil goes to plant and South America goes to plant, they will plant every acre available down there into one of those crops if there's a price bias one direction or the other. So again, you have to remember there's going to be a reaction if these prices continue to appreciate the way they've done. Now, it's going to be interesting to see what Brazil ends up doing. A lot of it's going to be contingent on how their summer or their winter crop, our summer corn crop ends up turning out, because right now they've got roughly about 650 corn down in Brazil. They've got some dry weather. They have tremendous livestock. Andrew can touch on that, but they need corn to feed their livestock industry. So they've kind of put themselves in a position where they're a little short. So there might be an incentive to plant some corn as well. So it's a continual tug of war between those commodities. This is specific to lower middle Tennessee. This is average cash soybean and nearby futures price. You can see that it typically tracks the futures price very closely. Our current harvest cash forward contract prices are around 11.14 to 11.54. So if you want to contract out October, November, those are the prices that you're looking at for lower middle Tennessee currently. I think the question that producers really should be asking themselves right now is, am I making money on at those prices? And if so, what's the appropriate amount to price? Those are going to be individual decisions. But again, I think we can get some profit if we're looking at this 11.54 or anything above $11. We should be looking at a little bit of profit if we can get average yields. Now, it's a big if, so you don't want to overprice, but getting your foot in the door is probably a pretty good notion at these prices. Similar for corn. Corn's a little different in the fact that the basis is very beneficial in lower middle Tennessee. We have usually that 10 to 30 cent basis in corn, which ends up providing an incentive. So again, we're looking at corn right now up in that middle of the fours, which is maybe a pretty attractive place to start looking at potentially pricing some. Obviously, with the strong poultry industry down there, you want to be taking that into account as well, and thinking about, well, if I can end up getting a contract or something with one of the feed mills down there, might want to end up looking at what your options are available on that. I mentioned the basis. There is a little bit of a difference in basis between corn and soybeans in Middle Tennessee. So if you look, the blue bars are corn basis, the red bars are soybean basis in Middle Tennessee. For corn right now, we're right on our seasonal average of 31 cents over the futures contract. For soybeans, we're actually a little bit lower. We're actually at a negative basis down there, just barely, pretty much even, where we're typically, almost 10 cents above. So again, we've seen a little bit of a spread on that. I think a lot of that too, again, is that strong livestock industry down there is really helping out on the corn side of things. Plus, there's those drought concerns with the existing crop down there. There was that patch of dry area in Alabama and Tennessee. Oh. So what now? It's like I mentioned earlier. It's a very difficult marketing environment. There's some cautionary things that people should look at. I'm not sure right now if anybody that uses short hedges or the futures market, there's a tremendous amount of potential volatility in there. So I would be very leery about entering into a short hedge position, just because you're probably looking at some potential margining requirements and some continued volatility. So again, I'm not sure if that's the best route to go. What I recommend right now is to analyze, decide, and implement. So when you're analyzing, you really want to look at what is your cost of production, what is your break even for each field and commodity, how much do you currently have priced, what is your crop insurance covering, and what options do you have available? Do you have harvest storage? That can play a tremendous role in what you should or could be doing during the growing season and after harvest. We kind of went through the local, national, and global fundamentals. What are they telling me, and where might they be heading? There's always a good idea to end up mapping out some scenarios, kind of see where you think things might be going. And then related back to this cost of production and break even, where are you comfortable selling? I mean, obviously everybody wants to hit the absolute high in the market. We want to get as much money for our product as possible, but at the same time, you've heard countless stories about people, you continually wait. You set a sales target of $4.50 for corn. You say, well, no, I think it's going to go to $5 now. Well, it could go to $5, but it could go to $3.50 too. So again, you have to weigh the risk reward, but set those sale price targets and try to end up sticking with them. What is your current estimated production? Again, we've seen that dryness creeping into southern middle Tennessee. Has it affected yield in certain fields? There will be some fields potentially in lower areas where the yields won't be affected as much as if you're on some higher ground. So again, you want to look on a field by field basis. Where is my production changed? What is my production risk? Because one thing you really don't want to do is sign those cash forward contracts and then not have the sufficient production to meet those. That's counterproductive. You're basically just changing price risk for production risk. How much production do you want to have priced? Some people have varying levels of comfort with pricing. Some right now want to have 10 to 20%. Some are more comfortable pushing up into that 50%. A lot of that is going to match what you feel your production risk is. If you have access to irrigation, you can probably be on the higher side of that pricing. If you have storage, again, maybe you might want to end up reducing because you do have the ability to end up storing that crop and looking for prices further out. One I think a lot of people don't take enough time to really look at. We typically buy our crop insurance and then kind of step away from it after we've finished our final reporting and purchasing. But if you're just doing a straight revenue protection policy, what we have to remember is there's that spring price and that fall price. So again, if we end up going, I just used a typical APH of 120 bushels. The spring price for corn this year was $3.86. A 70% buy-up gives you a spring revenue guarantee of $324 an acre. Well, if we end up going through that price determination period in the fall, and that price goes up, so does your revenue guarantee. So again, you want to factor that into your marketing plan, because you do have some downside protection or a floor that's set by the spring price. If the harvest price is lower, you still use the spring price, but if the harvest price is higher during the price determination period, your revenue guarantee ends up going up as long as you don't have the harvest price exclusion. So think about where you are on your crop insurance as well, because that can play a very important role. This one is a table that I've come up. It's an Excel spreadsheet for those of you that like those types of things. And essentially what it does is it allows you to look at where your profitable price on the vertical axis and yield on the horizontal axis, where your profitable marketing opportunities are. What I've assumed is I've just taken our University of Tennessee budgets. We have a total all-in cost, including land rent and everything, of $428 an acre for soybeans. So how to read this is if you are projecting yield at 45 bushels an acre, prices right now at 11, that would translate into a $67 per acre profit. Now, the one thing that you always have to remember is we all know that prices are moving dramatically during the season, but so are yields. I mean, you're going to have to, maybe back when you were planting, you were targeting a 50 bushel per acre. Maybe that's not realistic anymore. Maybe you have to back that up to 40 or maybe even 35. You can then look and see where your profitable opportunities are, where some losses would occur, and adjust your marketing accordingly to look at these different price and yield combinations. I know it's easy to get fixated on one or the other, but at the end of the day, what we're really concerned about is dollars and cents. We need a combination of the product to sell and the high sales price, and that's how we're going to end up maximizing our revenue. So this, again, you can go in, you can put in any total cost number you want, and it'll automatically update these tables, and it allows you to end up looking at different scenarios. You can do a variable cost, excluding land if you're on owned land. I always suggest to do a total cost in to just see where you are on that. But again, this goes back to if you don't have an estimated cost of production, it's very difficult to generate these types of assistance in your marketing decisions. So the first step was decide. This one is a little tricky, what to do. Right now, I think it would be prudent to look at potentially selling if you don't have any corn or soybeans sold yet. The key is when. I think right now we've kind of seen a bit of a lull in soybeans after a tremendous run up this past week. It's kind of stabilized a little bit. So again, it's kind of looking for new information, new direction. It can move higher. There's no doubt about that, but it can also go down much lower. So how much? 10 to 20. And then one thing that I've been saying recently is to use a step-up approach. Add 10% for an additional 10 to 25 cent price increase. If you get to 50% or wherever that comfort level is, reevaluate and continually look at that production risk. Where are those yields estimated to end up being, and adjust your marketing accordingly. How to do it? There's a whole bunch of different options out there. There's cash contracts, options, and then futures. There's a whole combination and subset of different products that you can use as well. So if you look at cash forward contracts, advantages, it secures the cash price. You know what your price is. You don't have to worry about basis or futures declining. Disadvantages, again, you have to deliver a certain quantity and quality of products. You do have yield and production risk. You also potentially have counterparty risk. It's one of those ones you have to know who you're doing business with in all decisions, because other companies' risks affect your risk as well. So you want to be cognizant of who you're signing those deals with. Obviously, if you're dealing with a large international, multi-billion-dollar company, your risk can be reduced somewhat. If you're dealing with just one person and it's kind of a word-of-mouth transaction, just know who you're doing business with. The other disadvantage, if it continues up, you are locked in. You've committed to sell those bushels at a specific dollar amount. Do not trade price risk for production risk. Do not overprice. Again, it's one of those ones where we need to be very cognizant of where our production is relative to our marketing decisions. The short hedge, I mentioned I'm not a huge fan of selling the board right now. It secures a futures price, and it protects you against a futures price drop. It allows you to participate if your local basis increases. So if your local cash price is higher, it will allow you to participate in that. The disadvantage, if prices increase, you've already locked in your futures price. If basis is lower, you'll end up having a lower net cash price as well. The other one, margin requirements. When you see these tremendous amount of volatility, particularly in soybeans where we've had 45, 50 cent movements in a day, that can be very, very nerve-wracking when you are in a short or long position and it moves against you. It also can require a tremendous amount of available capital. So again, you want to make sure, I'm not completely against using these right now, but please just know what you're getting into on these, because you do have the potential where you might have to put in some additional capital. So you want to make sure you have that available should it be required. Because worst case scenario, if you sell and then you have to exit because you can't meet the margin requirements, you've amplified a loss. You haven't mitigated any risk at all. And then again, you still have to have those cash sales to offset the production if you're doing a true short hedge. Again, the volatility right now, there's been a tremendous amount, and I don't see that necessarily going away until we have a better idea of where this crop is going to come in at. Put options, I like put options. It sets a futures price floor, so you can take advantage of any price rallies. There's no delivery commitment. So since it's an option, you don't have to worry about having the production behind it, and it does not set a price ceiling on the futures market. So if we see a continued rally, you can participate in that rally. The other thing that's great, if you are just straight buying put options, there's no margin requirements. If you get into other option strategies, if you are selling any type of an option to partially offset a premium, then you can get into margin requirements. So you need to be careful with that. But if you're just straight buying a put option, a similar product that would be available at a local elevator would be your minimum price contract, where you're looking at setting that price floor, but still allowing yourself to take advantage of that price increase. The disadvantage right now, the premiums are pricey. I mean, they obviously factor in volatility, and as such, they will end up costing you some money. The way I always like to think about put options is it's crop insurance. You have it, you hope you don't need it. You hope that you can sell your product at a higher price, but you do have that bottom, that floor, where you can end up getting a good or a profitable return, hopefully. They do tend to expire with no value if you hold them to maturity, but again, that depends on where you're buying them and what you're using for them. If you're thinking of it as an insurance one, you kind of hope that it expires with no value, because that typically means that you've got a higher price for it. And it does not protect against basis change. So if you do see a basis swing down in Middle Tennessee, that won't be protected by a put option. It does provide downside protection, but it is pricey in this environment. I'm not going to go through this table. I will post this presentation, so if you really want to take a look at this gives you all the other different types of marketing instruments that are out there. So anything from cash marketing, hedge to arrive, basis contracts, and then it kind of gives you an idea of what the impact is if you have a rise in futures or a change in basis, and what the impact would be on your position. And then it also gives you an area of risk exposure. So this is one of those ones where if you're looking at, well, you know, I'd like to see what options are out here, this gives you an idea of what your options are and what some of the positives and negatives of different alternatives are. So the next one I will say, I mean, we go through all this analysis, we look at supply and demand, we look at the current price environment, we analyze our crop insurance. At the end of the day, you have to implement. If you don't execute your marketing plan, you really haven't really accomplished much. You've maybe increased your knowledge and prepared you for future decisions. But again, if you don't implement something, you don't take advantage of a profitable opportunity, the other steps really aren't going to matter, because by the time we get to harvest, the whole supply and demand picture could be completely inverted. If you think about back to the winter marketing meetings, and I will tell you flat out, I was not bullish on corn or soybean prices when we were doing January, February grain conferences. I think the vast majority of people were not bullish, and now we've seen prices really creep up. So again, these can really move quickly. So if you don't take advantage of the opportunities when they're there, they can disappear very quickly. I got a quote here from Richard Brock. He's a grain marketer. He always goes out to the Mid-South Farm Financial Conference out in Martin, but he said it would be highly unlikely that anyone would go broke selling 20% of their crop at one time, sell 20% at a profitable level, and hope you were wrong so you can sell the remaining 80% at a higher price. I think it highlights the importance of actually doing some in-season pricing. I really caution people putting all their eggs in one basket, selling at harvest. Obviously, if you have storage, it opens up more options for you. But again, you want to try to spread out some of those sales and mitigate your risk. So again, just kind of take-home message: develop that marketing plan, analyze, decide, and implement it. Again, I think markets are going to continue to be volatile, and we're going to continually see these prices move as we have more information about what's going to happen with the weather. I think it'll be very quick, particularly if we get some timely rain as we enter into July. I think we could see a very sharp reversal. If it dries out, I think there's another leg to go up. So again, it's something where it's a very challenging marketing environment right now on the crops, because there is still, there's that underlying supply concern that we've had the past about 2 years, where if we add another large crop onto it, we'll see prices retreat substantially. There's other areas of the world. I don't want to just focus in on the U.S. because there are other production regions that are very important, primarily South America, but also when you look to Russia, Ukraine, and China as well, there's going to be some tremendous volatility over there too. So these things are going to continue to move as new information comes out. So you really want to try to capitalize if you can lock in some profit.